Hi, this is Harsh, and today we will discuss a very important aspect about the stock market. Now, a stock market has been a place for rags to riches and even riches to rags. So, we always talk about how to make money in stocks, mutual funds, and today we will talk about how people actually lose money in the stock market. What are the factors that cause us to lose money in a market where the index has become 100x in the last 30 years? What are the human biases that we suffer from as individual investors that cause us to lose? सबसे पहले number one, we'll talk about action bias, and this something I have suffered from, and I think is the most crucial one where people lose money. We think the stock market with flashing lights and changing prices induces us to action. It's a call for action. कि कुछ करो, press a button, buy something, sell something, hedge something. But the point is, real money is not made in the buying and selling of stocks. It is made in the waiting. Charlie Munger once said that do not unnecessarily interrupt compounding. So the real thing about the stock market, it goes against human emotions. Doing nothing is doing something. That's the best thing. If you have the right stock, the right company, जो company के owners है, promoters है, they don't buy and sell their stocks every day. Their wealth keeps on increasing over time. We have to think and be and behave like an owner. What we do is we are jumping ship, doing buying, doing selling, our brokers recommending us something. So we suffer from this action bias. Also, every time we take an action, we are losing money. We are paying brokerage, paying taxes on our gains to the government. So even this action costs us real money, tangible money. It makes us indecisive. So that is one bias we should try to avoid and take as little action as possible. The second thing we suffer from is recency bias. We are very infatuated, very much enthralled, very much captivated by what is recently doing well. For example, if I was in the year 2000, I would be very interested in millennium, the new millennium, the IT stocks, how the world will change. In COVID, I would be interested in pharma. In 2008, maybe in banks. So the trend, my friend, keeps changing. What is new, what is relevant, what is wonderful keeps changing. And we always think, okay, the world's moving towards this direction. Now it's like defense, capital goods, government stocks, and so on. But the stock market, if you see in the long run, rewards original thinking and judgment. We don't care what's going on. The prices are increasing in certain sectors or not. We have to care whether we see value in a certain script or certain story at this juncture in time or not. How long can we keep it, and are we patient enough to see it through a little bit of thicks and thins, right? So this recency bias has to be avoided. What happens intuitively, we get caught in the top of a cycle. The smart money is buying at the bottom, accumulating. The stock prices run up because things change, and we end up buying at the top point of the cycle, and then those prices never come back. The third thing that we suffer, and which is, I think, if we learn this, then we've pretty much understood 50% of the stock market already, is anchoring bias. Anchoring क्या होता है? What is anchoring? We anchor the stock price on something, right? So basically, if I say कि एक stock का price 800 था, $800, and now it's 500. So is it expensive or is it cheap? All of you would obviously say it's cheap because you've anchored it to 800. If I say it was 100 and now it's become 500, would you say it's expensive or cheap? You would say it's expensive because you've anchored it to what it used to be. But in business, that is not how business works. If you have 3 shops, one is doing very, very well, one is not doing well, and one is doing very badly, your fresh capital will go towards the shop which is doing very well. So there's natural momentum bias to your investments. What I'm trying to say is business is not like real estate. The value changes dramatically and it changes fast, right? So we have to judge it without any bias to what it used to be. We have to only keep looking forward and see whether it makes sense at this price or not, whether the risk has changed at this price or not. And most of the time we are trying to hunt for bargains because our nature is of more of a discounted. We want something cheap. So it looks cheap is expensive. What looks expensive is usually cheap. So these are the 3 biases which intuitively just play with our mind, because this is against human nature to buy more expensive, to do nothing, and to buy things which are not doing well recently. These 3 things make no sense to the average human being. But if we can train our brain in markets to think originally and to behave in this manner, then I really think, and if you really backtest in any market, you will see a lot of success in those things, right? So I want to leave you with this little nugget of wisdom to avoid, to understand, to sort of like simmer these three biases and work with it and avoid them in investing. Use your own judgment and try to not be use stocks like fashion, going in and going out. And I feel over long run you will learn a lot and you'll produce an amazing result as well. Thank you.